everyone, and welcome to Introduction to Taxes for Individuals. Today we're just going to be looking at a very basic example of how to record taxes for individuals. I'm sure, as you know, you have to pay your taxes every April 30th, and that's what we're going to be looking at today, is just how to do the taxes for one person. The nice part is that it's a 5-step process, and if you follow the process every single time, you should get to the correct amount of taxes owing to the federal government. Just want you to note that we're only going to be looking at federal taxes, and we're going to be leaving out provincial taxes. So let's get started. Hopefully you have your Word document resource with you. And this just goes through the steps of exactly how we do this. So for the very first part, or step 1, we calculate what's called net income for tax purposes. So this is where, if you are an employee for a company, you would receive a T4, and they would say, okay, well, you have employment income, let's just throw a number out here, of $37,000. That's how much you made working for whatever Canadian company that you're working for this year. If you had business income in the year, so let's say you run your own small business, maybe it's even something small like you drive for Uber or something like that, and that's considered your own small business. Selling Tupperware, anything like that would be considered business income. So let's just, and again, these numbers are likely going to be given to you in this very introductory course, or for tax, for what we're going to be looking at. So we'll say we have employment income of $37,000, and let's just say we have business income of $15,000. I'm choosing high numbers so we can see how everything works here. So any property income, this is also kind of investment income, would also be included in this step 1 format. So here we're just looking at, okay, well, what is everything you made in the year? Let's pretend that we have an investment in a business where we are a shareholder, and that business did really well this year, and we received a dividend. What happens with dividends is, because the business that you are a shareholder in, they would have had to pay what's called business tax. And so what's happening is, then they would also give you a dividend, and you would have to pay tax on that dividend. So what we're going to do here is we're going to say that we have a dividend. And to keep it simple, we'll just say that it's $1,000. So we have to include this $1,000 dividend into our income. The other thing that we have to do is called a gross up, or a dividend gross up. So we would have to include, now the rate is 38%. We're going to be basing all of our rates are from 2019. The gross up is 38%. So that means that we would have to add 38%, so $380, into our income as well. And how this works is that we have to include more into our income initially, and then you'll see that we actually get a credit for this income later on. And the government has made it this way to avoid double taxation. So to avoid the company paying the same amount of tax as what the individual has to pay. So you always have to gross up a dividend, and then you'll see later on that we will actually get a dividend tax credit as well. The next part I want to talk about is this income under Income Tax Act 3B. This is where we have taxable capital gains and allowable capital losses. Now, this is all from the sale of real property. So any stocks that you own, bonds, any expensive art, anything that you would have that's considered an asset that you may have sold in the year, you might either have a gain or a loss on that sale. So what happens is, if you have a taxable capital gain, okay, so let's say that, for example, we sold a bond that we had, and we sold it at a gain, and we made $1,000 on that bond. So this $1,000 is considered a capital gain. Now, in order to make it a taxable capital gain, the rules for CRA are very clear that you only pay 50% on any taxable capital gains or allowable capital losses. So that means that we actually only have to include 50% of this gain into our income. So we would have taxable capital gains of $500. Now we need to look at, okay, well, what if there's allowable capital losses in the year? So let's pretend that we also have an allowable capital loss. So let's say that we sold a piece of art and we didn't get as much as we originally paid for it. So therefore we have a loss of, let's say, $300. Again, to make it an allowable capital loss, it means that we get to reduce our income by 50% of that, so by $150. So because it's a loss, we get to take that away from our income, but it needs to be deducted against our taxable capital gains. So the thing about taxable capital gains and allowable capital losses is that capital losses can only be deducted against capital gains. So therefore, if you had a loss in the year but no gain, you actually wouldn't be able to use that loss this year. You'd have to wait until the future when you actually had a gain where you could use that loss. So this would give us $350 of taxable capital gains. And so that would also have to be included into our income for the year. So we'll add in our $350. Now, these next sections here, so income under ITA 3C and losses under ITA 3D, if we had any losses in the year from employment or business or investments or property, this is kind of where they would belong, is under the ITA 3D section. That's a little bit too complicated for what we're doing for this course. So at this point, we're just going to focus on, okay, well, what did we have for income under ITA 3A? Was there employment income, business income, investment, or property income? And then we'll look at income under ITA 3B. Did we sell any assets in the year that had a capital gain or a capital loss? And if so, in order for them to be considered taxable or allowable loss, we only have to pay 50% of what we actually had for a gain or a loss. So that's going to be our main focus for this step 1. So now we can go ahead and we can total up, okay, well, what is our net income? Our net income for tax purposes. So we will just add the $37,000, the $15,000, plus $1,000, plus $380, plus our $350, and we get a grand total of $53,750. So that is our net income for tax purposes. So that's everything we made in the year. Step 2 is determining, we start with our net income for tax purposes. So we calculated that in step 1. So we'll just kind of bring it down and start step 2. Sorry, there we go. $53,750. Now, This part, again, is a little bit complicated. So normally, like for example, there's this northern residence exemption. It's just basically an added deduction if you lived in like the Northwest Territories area where the cost of living is a lot higher. It's just something that the government gives you in order to decrease your income every single year. But we're just going to avoid these deductions because they're a little bit too complicated for what we're dealing with in this course. So this step really is just going from net income for tax purposes, and we're trying to get to taxable income. And because we're not going to dive into details, it's just going to be the exact same number. So it's going to be our $53,750. And now instead of it being called net income for tax purposes, it's going to be called taxable income. Step 3 is where we are going to figure out, okay, well, how much do we actually owe for taxes? How much do we owe the government? And this changes every single year because tax rates change likely every year or with a change in government. Same with tax credits. So for step 3, I'm just going to take us down, I'm just going to scroll us down to this little chart here, and we're going to talk about how progressive tax rates work. So these are just individual federal tax rates, so they don't include provincial taxes. So for example, if you make $47,630 in a year, you would be taxed at 15%, meaning that you would pay $7,145 in tax for that year. Now, the next part would be, okay, well, if you make between $47,631,000 and $95,259,000, your new tax rate is 20.5%. So meaning that on the first $47,630, you would pay 15%. But anything extra that you make after that, up to $95,000, gets taxed at a higher rate. Therefore, the more money you make, the more taxes that you pay. So let's just look at what this looks like for our current example that we're going through. We have taxable income of $53,750. So we'll just go taxable income $53,750. So the first $47,630 is going to be at 15%, which the chart already tells us is $7,145 that we for sure owe in tax. For this next part, we have to say, okay, well, we'll go our $53,730 minus the $47,630 gives us $6,100. I'm just going to double check the math on that. Yes, $6,100 of income in the next bracket. So this income is going to be taxed at 20.5%, leaving us with $1,250.50. To make this easy, I'm just going to round it to $1,251. So now what happens is I'm just going to add up the total amount of tax that we owe. So we'll say, okay, federal income tax on taxable income. So I'm going to take my $7,145 and I'm going to add it to $1,251. And that is going to give me $8,396. And that is how much I owe in tax for the year. So this is step 3. So when I go up here, I'm just going to say, okay, federal income tax on taxable income is going to be our $8,396 that we calculated. Step 4 is deducting our non-refundable tax credits to determine net federal tax. So you may have heard of the term tax credits before, but if you guys probably receive tuition credits. There's also credits just for anyone. There's credits for if you have a disability, you might get further credits. If you work for a company in Canada, you might get further credits. So I'm going to go through some of the basic credits in step 4 that we would see and that you might have to know for this course. So let's just go step 4. And again, these are all just laid out by the government. So depending on who is currently, if it's the Conservatives or if it's NDP, these rates that we're given as well as these credits can change all the time. So we really have to pay attention as accountants to say, okay, well, what's new? What do our clients qualify for? What do our individual tax returns need? So there's always going to be the basic tax credits that are non-refundable. So actually, I'm just going to write that. All right, non-refundable tax credits. And these are always at 15%. So, for example, everyone qualifies for the basic tax credit, which is $12,069 in 2019. Because this individual has employment income, as we saw up above, they have employment income, they likely received a T4, and it's very likely that they work for a Canadian company. So we are just going to assume that it's a Canadian company and that therefore they qualify for what's known as the Canada Employment Tax Credit, which is $1,222 in 2019. Also, the individual would pay into EI. So because they pay into EI every year, they get an EI tax credit of $860 and CPP for $2,749. Now, all of these numbers are going to be provided to you, or you could look them up online depending on whatever year you're filing taxes for. So in our case, we're looking at taxes for 2019. These rates will all have changed from 2018, so it's important to look them up every single year. So let's say that that's all we qualify for. So our total tax credits is $16,000, if we add them all up, $900. And at 15% is what we get to reduce our taxable income by. So that leaves us with $2,535, which we get to reduce our income by. So if we scroll up, it says, Step 4, deduct non-refundable tax credits to determine net federal tax. So we have figured out that with all the tax credits that we qualify for as an individual, we get to deduct $2,535 from our federal taxes owing, from our $8,000. So $2,535. So this is step 4. And step 5 is basically just looking at the difference. So In step 5, we know that we owe $8,396 minus what we owe, minus our credits that we've received. So 8,396 minus 2,535 leaves us with $5,861, and this would be our net federal taxes owing. For 2019. So that means that we would have to write a check to CRA for $5,861 at the end of April to pay for our 2019 taxes. So that's basically how federal tax works. You always just follow these 5 steps, and I've kind of just highlighted the important parts that we're going to be, or that you will be covering in FINS 150. So you have your step 1, calculating net income for tax purposes. Here we're just focusing on, okay, well, what money came in to you in the year? What money did you earn this year? Step 2 is looking at going from net income for tax purposes to taxable income. Now we know that for this course, it's just going to be the same amount. So our $53,750 just remains $53,750. Step 3 is where we have to figure out how much money we've made and which tax brackets that we fall into. And because tax brackets are progressive, it means that for the first $47,630 that we make, we're going to be paying $7,145. And then for anything extra or above that, the next amount we would have to pay is 20.5%. If we made over $95,259 in the year, we would have to figure out, okay, well, how much more did we make than that amount? And we would actually have to pay 26% tax on anything further than that. So like I said, the more money you make, the higher taxes that you pay. And then in step 4 is where we look at our tax credits. And there is a PowerPoint attached here that's going to go over the tax credits that you are expected to know for this course. There's tons of tax credits, and there's always going to be changes to them. One thing I did want to mention is that some tax credits, so here we have our non-refundable tax credits at 15%. Sometimes there are tax credits that you can earn that aren't at 15%, that have their own rules and regulations. So for example, I wonder if I can add a page here, just a sec. Yeah, let's just see if this works. So for example, let's say that we had charitable contributions, or that we made some sort of donation in the year. So if we made a donation in the year, that's also considered a tax credit, but it's not at the 15%. So let's say we made a $50 donation, we would actually get 15% of that back. So 15% of $50 is, I think, $8. Yeah. So 7.5, we're just going to round it to 8 for simplicity. So we would get an additional $8 tax credit, meaning that if we looked at the amount we owe, we would have this additional credit. So it would say donation credit. And again, it would be our 50 times 15%. For $8, and we would just add that $8 to the tax credits that we've already calculated. So something else to watch out for is just the different types of tax credits that you can qualify for. And once you figure out the amount of tax credits you have, basically you take the difference, and here we have federal taxes owing still of $5,861. But for a lot of you who are students, it's very likely that you'd get a refund in the year. So it's very likely that the amount of tax credits you have would be a larger number than the amount of tax owing that you have in the year, then you would, let's say, have a $1,000 refund that you would get, and CRA would mail that to you or directly deposit into your account. So this is just a quick introduction to tax with a little example for you to go through. There will be a couple of slides and a reference for you with this this steps sheet that informs you of what to do. So I hope that was helpful, and let me know if you have any questions. Thanks so much.